everyone, I'm Mr. Broke Bradley. Let's not waste any time and jump straight into it.
Every single day, trillions of dollars worth of ownership in the world's biggest companies changes hands. Most working people have heard of this system their entire lives. Almost none of them understand how it actually works. Today, that changes. Bradley has heard about the stock market his entire life. He has heard the numbers, he has heard the crashes, he has heard people say they made money in it, and people say they lost everything in it. But if you asked Bradley right now to explain in plain language what the stock market actually is, he could not do it. And Bradley is not alone. Research consistently shows that financial literacy, specifically understanding basic investment mechanisms, remains one of the most significant knowledge gaps among working adults globally. Today, FinWise Edge closes that gap completely, in plain language, with zero jargon and zero assumptions about what you already know. To understand the stock market, you must first understand something more fundamental: why companies need money from outside sources in the first place. Imagine Bradley decides to start a small business making and selling furniture. He starts small, he earns enough to cover his costs and pay himself a modest income. The business works. People like the furniture. Then an opportunity appears. A large retailer wants to stock Bradley's furniture in 50 locations across the country. It could multiply his revenue 10 times over. But to fulfill that order, Bradley needs 10 times more equipment, hire 20 new staff, and expand his workshop significantly. He needs $500,000 he does not have. Bradley has three options. He can borrow the money from a bank and pay it back with additional charges over time. He can find a private investor who gives him money in exchange for a share of the business. Or he can go public, meaning he offers small pieces of ownership in his business to thousands of ordinary people in exchange for their money. Option 3, going public, is what the stock market is built on. And understanding this single idea explains everything else about how the market works.
When a company decides to go public, it divides itself into millions of equal pieces. Each piece is called a share. Each share represents a tiny fraction of real ownership in that company. If a company divides itself into 1 million shares and you own one share, you own 1/1,000,000th of that company. That ownership is real. It is not theoretical. As a shareholder, you are a part owner of every asset that company owns, every building, every piece of equipment, every product in their warehouse. You also have the right to a proportional share of any profits the company distributes to its owners. These payments are called dividends. And you have the right to sell your ownership stake at any time to anyone willing to buy it at whatever price both parties agree on. That ability to buy and sell ownership stakes freely at any time is what creates a market, and that market is what we call the stock market. Now, the question everyone wants answered: why do stock prices go up and down, and what actually drives those movements? The price of a share at any given moment is simply the price at which the most recent buyer and seller agreed to exchange ownership. Prices rise when more people want to buy a share than want to sell it, because buyers must offer higher prices to convince sellers to part with their ownership. Prices fall when more people want to sell than want to buy, because sellers must accept lower prices to find willing buyers. But what makes people want to buy or sell in the first place? Three main forces drive this: company performance, economic conditions, and market sentiment. Force 1. Company performance. When a company earns more profit than expected, more people want to own it. Demand rises, price rises. When a company earns less than expected or announces problems, fewer people want to own it. Supply rises, price falls. Force 2. Economic conditions. When the broader economy is growing, businesses generally earn more, which makes their shares more valuable to own. When the economy contracts, businesses generally earn less, which makes their shares less valuable and prices tend to fall. Force 3. Market sentiment. This is the collective mood of all investors at any given time, and it can sometimes move prices significantly, even when company performance has not changed. This is why markets sometimes seem irrational, because human emotions are part of the price discovery mechanism, and human emotions are not always rational. Now, here's where the documentary gets genuinely important, because understanding short-term price movements is interesting, but understanding the long-term reality is what actually matters for ordinary people. Over any short period, weeks, months, even a year or two, stock market prices can be extremely volatile and unpredictable. But over long periods, decades, the historical record of broad market indexes shows a consistent pattern of long-term growth despite short-term volatility. According to data compiled by multiple financial research institutions, broad market indexes tracking the largest companies across developed economies have historically produced positive returns over any 20-year period in recorded market history. This does not mean the market always goes up. It does not mean crashes don't happen. Crashes do happen regularly, and they are painful for everyone who experiences them. But the historical evidence consistently shows that the market has recovered from every single crash in its history, and ultimately has reached new highs after each one. The critical variable, the one that determines whether market participation works for an ordinary person, is time in the market. An investor who stayed invested through every crash in the last 50 years, who did not panic and sell, ended the period significantly wealthier than one who held cash instead.
Now, let us bring this down to earth, because understanding how the stock market works is only useful if you know what it means for you as an ordinary working person. First, the stock market is not a casino. A casino is designed so that the house always wins over time. The stock market is designed so that as the economy grows, all owners benefit proportionally. Second, the stock market is not just for wealthy people. With modern brokerage platforms, many regulated markets now allow participation with very small starting amounts. Third, the biggest risk in market participation for ordinary people is not the market itself, it is behavior, specifically panic selling during downturns. When markets fall, and they will fall, the natural human emotion is to sell everything and escape the pain. But selling during a fall converts a temporary paper loss into a permanent real loss. Fourth, diversification reduces risk. Owning small pieces of many different companies across many different industries means no single company failure can devastate your entire position. Fifth, and most important, before participating in any market, understand exactly what you are buying, why you are buying it, what your time horizon is, and what you can afford to have tied up for years. Bradley sits back and looks at everything he just learned. For the first time in his life, the stock market does not feel like a mysterious black box that only clever or wealthy people understand. It feels like what it actually is, a market, where ownership in real businesses is bought and sold, with real historical data, real risks, and real long-term potential for patient participants. The stock market is not a mystery. It is not a gambling den. It is not exclusively for the wealthy or the educated. It is a mechanism, a system where ownership in productive businesses changes hands, where patient participants have historically been rewarded, and where knowledge is your most important starting point. If this video gave you clarity on something you have heard about your entire life but never fully understood, share it with someone who deserves that same clarity. This has been FinWise Edge, the financial education the system never gave you.
Bye-bye!